You're going to receive Form 1099-DA for your 2025 crypto transactions, and most investors will handle it wrong. There are 6 specific steps you need to take before filing, and if you skip even one, you'll either overpay on taxes or face an audit. Here's what you need to understand. 2025 was the critical transition year. Exchanges will report what you sold crypto for, or what we call the gross proceeds, but they won't report what you paid for it, the cost basis, until 2026. This creates a dangerous gap where you're responsible for tracking your own cost basis. And if you can't prove it, the IRS might assume you paid $0 for everything. I'm going to walk you through exactly what Form 1099 is, why 2025 was the critical transition year, and the 6 steps to handle your crypto taxes correctly for this tax filing season in Q1 of 2026. I'm John Conrad with Numeratus. We're a white glove accounting firm specializing in crypto tax compliance, everything you can imagine a big firm doesn't want to touch. Complex crypto portfolios, DeFi transactions, wallet level reconciliation. That's what we do. We've been preparing for Form 1099-DA implementation for months. We've reviewed the IRS instructions, analyzed the staged rollout, and developed processes to handle the 2025 transition period correctly. That brings us to point number 1, what Form 1099-DA actually is and why it matters. So Form 1099-DA is the digital asset proceeds from broker transactions. It is the IRS's new reporting form for cryptocurrency and digital asset transactions. It's essentially the crypto version of Form 1099-B, which stockbrokers have been filing for decades. So what gets reported in 2025? Starting with your 2025 transactions, crypto exchanges like Coinbase, Kraken, Gemini, Binance US must report to the IRS. And what they'll report is your name and taxpayer ID, the description of the digital asset sold, the date of the sale, the gross proceeds, so what you sold it for, whether the transaction was short-term or long-term, short-term being less than 12 months or long-term being more than 12 months. So what's not reported in 2025? And this is critical. Your cost basis, that means what you paid those cryptos for, are not reported on 2025 forms. The exchanges will report what you sold it for, but not what you bought it for. So what changes in 2026? Starting with 2026 transactions, exchanges must report everything from 2025. Plus, you will additionally need the cost basis, what you paid for, gain or loss, whether specific identification was used, the per wallet tracking information. For example, an investor sells Bitcoin in 2025. Coinbase reports the sale to the IRS on Form 1099-DA, showing the investor sold $50,000 worth of Bitcoin. But Coinbase doesn't report that the investor paid $30,000 for that Bitcoin. That's the investor's responsibility to track and report. If the investor doesn't report their cost basis correctly on their tax return, the IRS might assume they paid nothing for it. Now they owe taxes on the full $50,000 instead of just paying the $20,000 gain. That's double the tax bill, potentially $15,000 in taxes instead of $6,000 in taxes, just because of poor record keeping. This is why 2025 is such a critical transition year and why you need to get this right. This brings us to point number 2, the 2025 transition problem, the dangerous gap. So 2025's tax year creates a unique and dangerous problem that most investors don't understand. There's a gap between what the IRS sees and what you report. The IRS receives Form 1099-DA, just like any other 1099. And the 1099-DA comes from exchanges showing you sold crypto for, let's say, $50,000. They don't see your cost basis. They don't know if you bought it for $10,000, $30,000, or even $45,000. Your tax return needs to reconcile with what the exchanges report. If you report a sale, but can't prove your cost basis, or if you don't report the sale at all, their systems flag it automatically. So why is this so dangerous? Why do most people not realize it? Many investors have poor records. They've bought crypto on multiple exchanges over multiple years. They've transferred between wallets. They've lost access to old exchange accounts. They don't have clean documentation of their cost basis. And this is something that Numeratus has experience in with a number of clients who go through this same scenario. When they file their 2025 taxes, they might guess at their cost basis and guess wrong. They might underreport their basis and overpay thousands in taxes. They might not report crypto transactions at all, thinking the IRS won't notice because they never cashed out. They also might mismatch their reported proceeds with what exchanges report, triggering automatic audit flags. So what actually happens? The IRS receives Form 1099-DA showing you sold $50,000 in crypto. You don't report this transaction, their computer systems automatically generate a notice. You'll get a letter in the mail saying you failed to report the $50,000 in income. Or you report the sale, but you can't prove your cost basis. The IRS assesses taxes on the full $50,000, assuming zero cost basis. You owe potentially $15,000 in taxes on money you didn't actually make. For example, an investor sold crypto throughout 2025 on 3 different exchanges. Each exchange sends a Form 1099-DA to the IRS, showing total proceeds of $100,000. The investor doesn't realize they need to report these transactions and record them with their own cost basis records. They just file their regular tax return and don't include anything related to crypto because they think, I didn't really make money. Crypto went down this year. The IRS receives the 1099-DA form showing $100,000 in sales. The investor reported nothing. The computer system generates an automatic CP2000 notice assessing taxes on the full $100,000, as if the cost basis was zero. The tax bill, $30,000, plus penalties and interest, all because they didn't understand the reporting requirement. Point number 3, FIFO versus specific identification. Your last year of full flexibility. One of the most important decisions you'll make for crypto taxes is which cost basis method you'll use. And 2025 is the last year you have full flexibility before exchanges start tracking everything. This is understanding the methods. Let's start with FIFO. First in, first out. This is the default method. The first crypto you bought is the first crypto you sell. This is simple, but often creates higher taxes if your earlier purchases were at low prices. Let's say you bought Bitcoin at 3 different times. $20,000 in 2020, $50,000 in 2021, and $30,000 in 2023. If you sell $50,000 worth of Bitcoin using FIFO, you're selling the 2020 Bitcoin that you bought at $20,000. Your gain, $30,000. And now let's go to the specific identification. This allows you to choose which specific units of crypto you're selling. This can minimize taxes by selling higher cost units first. Using the same example, if you specify you're selling only the 2021 Bitcoin that you bought at $50,000, your gain is zero. You pay no taxes. That's a difference of $9,000 in taxes at a 30% rate, just from choosing your method. So why is 2025 so critical? In 2025, because exchanges aren't reporting cost basis yet, you had more flexibility to use specific identification. If you have proper records proving which units you sold. Starting in 2026, exchanges will track cost bases using their own methods, likely FIFO unless you specify otherwise at the time of the sale. It becomes much harder to use specific identification retroactively. So what's the documentation required? Specific identification only works if you can document which specific units you sold. This requires records on when you bought each unit, records of the price you paid, documentation that you specified which units to sell at the time of the sale, and consistent methodology. For example, an investor bought Bitcoin at 3 different times with 3 different cost bases. In 2025, they sell some Bitcoin. If they have proper documentation and use specific identification, they can choose to sell the highest cost basis unit first, minimizing their tax bill. But if they just sell Bitcoin and don't specify anything, and they don't have good records, they'll be stuck with FIFO by default, which could cost them thousands more in taxes. 2025 is the year to get your records in order and implement specific identification correctly before exchanges start automatically tracking everything in 2026. By the way, we handle wallet level reconciliation and cost basis optimization here at Numeratus. If you need help implementing specific identification strategies and documenting everything properly, that's what we do. But let's get back into it. Point number 4, per wallet tracking, the new reality coming in 2026. So we're here in 2026. Exchanges will implement per wallet cost basis tracking. This fundamentally changes how crypto accounting works, and you need to understand it now. So what per wallet tracking means? Each wallet or account will have its own separate cost basis calculation. If you have Bitcoin in 3 different wallets, each wallet tracks its own cost basis independently. You can't just aggregate all your Bitcoin and just use one overall cost basis. Each wallet is treated as a separate bucket. So why does this matter? If you've been moving crypto between wallets frequently, this creates complexity. Each transfer might be treated as a disposition and reacquisition with a new cost basis for the receiving wallet. So what's the impact on your taxes? Let's say you have Bitcoin in Coinbase wallet and you bought it at $30,000. Let's say you have a hardware wallet and you transferred from Coinbase. Basis remains at $30,000. Then you have a Kraken wallet and you bought it at $50,000. In 2025, you could potentially aggregate these and use any reasonable method to calculate your overall basis with proper documentation. In 2026, each wallet tracks separately. If you sell from the Kraken wallet, you must use the $50,000 basis specific to that wallet. You can't use the $30,000 basis from Coinbase just because it's more favorable. So what do you need to do now? Start tracking per wallet now before it becomes mandatory. This means document which wallets hold which crypto. Track when crypto was acquired in each wallet. Understand the cost basis for each wallet separately. Plan your sales strategically based on which wallet has the most favorable basis. Consider consolidating wallets if it makes sense for your tax strategy. Many investors will need to completely restructure their wallet strategies before 2026 to optimize for per wallet tracking. The time to plan is now in 2026, not when you are already under the new rules. That brings us to point number 5, the common Form 1099-DA mistakes. So what will get you audited? Let me be very clear about the mistakes investors are already making with Form 1099-DA that will trigger audits and penalties. Mistake number 1, ignoring the form. Some investors think they don't receive a 1099-DA. Maybe their exchanges don't even send it, or it gets lost in the mail, or they moved and they didn't update their address. They feel like they don't need a report. This is completely wrong. You're required to report all crypto transactions regardless of whether you receive a form. The IRS still gets that form even if you don't. So mistake number 2, reporting only what's on the form without cost basis. The 1099-DA shows gross proceeds but not cost basis. If you just report the proceeds from the form without providing the cost basis calculation, the IRS completely assumes $0 in basis. You need to complete Form 8949, showing both proceeds from the 1099-DA and your cost basis calculation. Mistake number 3, mismatching transaction amounts. The IRS matches 1099-DA forms to your tax return down to the dollar. If the proceeds on your return don't match what the exchanges reported, you get a CP 2000 notice. Make sure your reported sales match exactly what the exchanges report. If there are legitimate discrepancies, you need to attach an explanation. Mistake number 4, not keeping your own records. Since exchanges don't report cost basis in 2025, you must keep your own records. If you can't prove your cost basis during an audit, the IRS will assess taxes based on no cost basis. That means 0. This means keeping purchase confirmation from all exchanges, transfer records between wallets, screenshots or reports of transaction history, and documentation of your cost basis calculation methodology. So mistake number 5, waiting until 2026 to fix your records. Many investors are planning to deal with it next year, but 2026 will have its own transactions to track. If you don't fix 2025 right now, you'll be perpetually behind and your records will get worse over time. For example, an investor receives a 1099-DA showing $75,000 in Bitcoin sales for 2025. They file their tax return and dutifully report the $75,000 on Form 8949, but they forget to include their cost basis calculation showing they paid $60,000 for that Bitcoin. They just leave the cost basis column blank or just put 0. The IRS processes the return and assesses tax on the full $75,000. The investor gets a bill of $22,500 in taxes when they should only owe $4,500. Now they have to amend their return, provide documentation, and fight to get the assessment corrected, all because they didn't include their cost basis the first time. Another example, an investor sold crypto on Coinbase, Kraken, and Gemini in 2025. They receive 3 separate 1099-DA forms showing total proceeds of $150,000. They calculate their taxes based on their own records and report $120,000 in proceeds on their return. They forgot about one exchange or missed some transactions. The IRS computer sees a mismatch. Exchanges reported $150,000. Tax return shows $120,000. Automatic CP 2000 notice. Now they're being audited and underreporting $30,000 in income, even though they might have legitimately had a loss on those transactions. They just didn't report them correctly. Point number 6, the 6 steps to handle your 2025 crypto taxes correctly. Here's exactly what you need to know for 2025 crypto taxes. Follow these 6 steps and you'll have peace of mind. Step number 1, gather all your 1099-DA forms, January through February 2026. So this is the prime time moment right now. Exchanges will send Form 1099-DA in January or February 2026 for your 2025 transactions. You need to collect them all. So here are some action items. Check your email and physical mail for every exchange you use in 2025. Log in to each exchange account and download your 1099-DA from their tax center. Make a list of every exchange you use to ensure you don't miss any. If any exchange went bankrupt or you can't access your account, contact their support to get your 1099-DA. If you used 5 exchanges, you should receive 5 separate 1099-DAs. Don't assume you only have one. Step number 2, reconcile forms to your own records. Before you do anything like file your tax return, verify that what the exchanges report matches your understanding of your transactions. Download your complete transaction history for each exchange. Match the transactions on the 1099-DA to your transaction history. Verify the proceed amounts are correct. Identify any discrepancies, so that means wrong amounts, missing transactions, or duplicate entries. Document any legitimate discrepancies with notes explaining why. If a 1099-DA shows a sale you don't remember making, investigate immediately. It could be an error, or it could be a transaction you forgot about. Step number 3, calculate your cost basis for every transaction. This is the most important step. For every sale reported on your 1099-DA, you need to calculate what you paid that crypto for. So here are some action items. Identify when you originally bought the crypto that you sold. Determine the purchase price, so your cost basis. Choose your cost basis method, FIFO or specific identification, and apply it consistently. And do bear in mind, if you did not choose specific identification in the past and had filed a safe harbor, then you cannot use specific identification. Document your methodology. Calculate your gain or loss, proceeds minus cost basis. If you bought Bitcoin at multiple times and prices, you need to figure out which specific Bitcoin you sold using your chosen methodology. This is where crypto tax software like coin tracking and Coinly or token tax becomes invaluable. They can automatically calculate this for you if you connect all your exchanges and wallets. But let me bear in mind, it's not as easy as just plugging it into one of these platforms, especially if you moved cryptos from one place to the other, into another wallet, into a defunct exchange, into DeFi, staking, and back. It becomes quite complex and becomes quite a nightmare to account for. Come to Numeratus, book a call, or join the community to learn how we can handle that for you. Step number 4, complete Form 8949 for capital gains and losses. Form 8949 is where you report each individual crypto transaction to the IRS. So here are the action items. List each sale separately. Date sold, description of crypto, date acquired, proceeds, cost basis, gain loss. Make sure proceeds match exactly what's on your 1099-DA forms. Include your cost basis calculation for each sale. If you have many transactions, use summary reporting, but keep detailed records. Check the appropriate box indicating you received a 1099-DA. Form 8949 has different sections for short-term, held 1 year or less, and long-term, held more than 1 year. So make sure you categorize it correctly. Step number 5, transfer totals to Schedule D and Form 1040. Once Form 8949 is complete, the totals flow to Schedule D, which is your capital gains and losses, which flows to your Form 1040. Transfer your Form 8949 totals to Schedule D. Calculate your net capital gain or loss. Apply capital loss limitations if applicable. So that's $3,000 max deduction against ordinary income. Calculate any capital loss carryforwards to next year. Report the final number on Form 1040. Most tax software automates this, but if you're filing manually, double check this math. Step number 6. Document everything and keep records for 7 years. The IRS can audit you for up to 7 years for significantly underreporting. You need to keep comprehensive records. Save copies of all 1099 forms. Save your complete transaction history from all exchanges. Document your cost basis calculations with supporting evidence. Save screenshots or PDFs of exchange confirmations. Keep records of wallets, transfers, and addresses. Store everything securely in a cloud backup and a local backup. If you get audited 3 years from now, you need to be able to prove every number on your tax return. For example, an investor in December 2025 should be downloading transaction history for all their exchanges now. Don't wait until January. Reconciling their current holdings across all wallets. Calculate estimated cost basis for all 2025 sales. Identify any missing documentation and try to recover it now. Use crypto tax software to automate the process if they have hundreds of transactions. An investor who waits until March 2026 when they receive their 1099 DA forms will be scrambling to reconstruct a year's worth of transactions in 4 weeks before the April deadline. Smart approach, start working on this now. Be ready when the forms arrive. File early and correctly. Form 1099 DA is here. And 2025 was the critical transition year where you're responsible for tracking your own cost basis. The exchanges will report your transactions to the IRS. But if you can't prove what you paid for that crypto, you'll get destroyed on taxes or face an audit. This video showed you what Form 1099 DA is and the 6 steps to handle it correctly, the before and the after. The bridge to actually getting your crypto taxes done right is where Numeratus comes in. If you want to stay informed about Form 1099 DA requirements, cost basis tracking methods, and crypto tax strategies and regulations, join Numeratus community at numeratus.org for $100 a month. We break down regulatory changes and tax requirements in real time, and we're tracking the 1099 DA rollout as it happens. And there's also other perks of being in the Numeratus community, specifically if you're an investor about to become an entrepreneur. If you need help, if you've got a 1099 DA and don't know what to do, if you need wallet level reconciliation and cost basis calculations for hundreds, even thousands of transactions, if you want professional guidance ensuring you're reporting everything correctly and you won't overpay, book a crypto tax review at numeratus.us. We specialize in crypto tax compliance and 1099 DA reconciliation. We handle the entire process, gathering your transaction history, reconciling across exchanges and wallets, calculating your cost bases using the optimal method, completing all your tax forms, and documenting everything for audit protection. The time is now, and the peace of mind is at hand, and it's priceless. That sounds interesting to you? Book a call.